Before we start, a brief disclaimer. This podcast is provided for general information and discussion purposes only and does not constitute investment advice, research, or financial promotion, nor an offer or solicitation to buy or sell any securities or financial instruments in any jurisdiction. The views expressed are those of the speakers at the time of recording and may not reflect the views of any organisation they are associated with. While information discussed is believed to be reliable, no representation or warranty is given, and no liability is accepted for any loss arising from reliance on it. Listeners should seek their own independent professional advice before making any investment or financial decisions.
Here today with Arnaud Gérard from FundRock. Arnaud, how are you?
I'm good, thanks. Good afternoon.
Good. So we're going to have a topic. The topic for today is European fund distribution. And you've been in this business for a very, very long time, Arnaud, not to age you, but I think experience matters. But could we just start off with a little bit of an introduction of yourself and FundRock?
Sure. So FundRock is that I'm responsible for. FundRock Distribution is a Luxembourg-based investment firm geared towards exclusively the investment advice and retention and transmission of order. We basically there to support foreign asset managers. I set up the firm about 6.5 years ago, after 30 odd years. So remind me the years there in London. I started in London back in the 90s as a quantitative hedge fund analyst, and then moved through the rank as a relationship manager for institutional investor, and then an institutional sales for EMEA. The firms I've worked with were from very traditional, like Wellington, Bank of New York Mellon boutiques, but also doing currency overlay for about 15 years. So exposure of quant and more traditional strategies.
Okay. And so today with FundRock, we'll get into more detail as we have the conversation, but who do you typically help the most? Like who are your key client segments?
So the key client segments typically are mid-sized asset managers, sometimes even large, surprisingly larger and very successful asset managers in their home country who suddenly decide to go international and therefore look at Europe as one big market that they would like to explore or raise assets from. So basically any non-European based asset manager would be the typical profile.
Okay. And so if you're working with a US or UK manager, what are the main routes to market that you kind of spend time with them when they're looking to raise assets?
So I suppose because of my background, I tend to recommend starting with an investment conversation, understanding their strategies so that I get a better understanding and conversation around who the competition's like, who they're going to be facing, which then leads to more naturally to, which countries would seem to be more natural for them to, or most likely for them to be successful, which segment in those countries. And that leads into, how best to wrap those strategies as a vehicle. Is it an alternative fund? Is it a UCITS? What sort of liquidity? Then leads to price. And then when you've got that all, I would say, well defined, then you can start a conversation around, is it a very disintermediated market where consultants are involved, or which platform should those funds be part of, or any databases to publicize their funds? So it's a very detailed, as much investment related and operationally related conversation.
Yeah. You mentioned fund platforms. What does that actually involve practically? Like, how do you get on them, and what are you doing?
Yeah, it's a bit like, I often take the analogy of having your baked beans on Tesco. For the British listening to this, they will understand. It's basically having your product on the shelf. Doesn't necessarily mean that you sell them. It just means that they're visible. So often platform would tend to define themselves as distributor, but in fact they're just, I would say, implementation or transaction enabler. You still need to have boot on the ground and push it among the fund buyers that use those platforms as a tool to execute.
Okay. And obviously regulations are a key component on fund marketing. Can you kind of walk through how you work with managers, especially ones who are raising assets from Europe for the first time? It might be a bit of a shell shock for them?
Sure. So the requirements would vary quite dramatically depending on the fund structure. But you need to think when you look at distribution in any regulated market, you need to look at two aspects: the instrument, the product you want to sell, and the people who will be doing the selling. So regarding the product you want to sell, the registration required will depend on the ultimate structure. Is that a local European fund or is it an offshore fund from a European perspective? And that leads to different requirements and a different procedure. With regard to the selling, the individual selling the fund, effectively, this is an activity that for most countries you need to be licensed for, even if you target only professional investors. And therefore, the asset managers has very much traditionally, asset managers have had two routes to take. The delegation, which take the route of a third-party marketer or an introducer of some shape or form that will basically prepare the ground, organize the meetings, and so on, or the much more committed route, which is to consider opening an office, creating substance in order to obtain a license with that office, and from that office being able to market. With FundRock distribution, we've created a third route, and some of our peers have created a third route, which is more connected to sort of tied agent or chaperoning model, where we help and assist managers to do it themselves, but leveraging on our existing license in order to operate more freely and directly connecting with investor.
Okay, and practically, kind of the regulatory oversight kind of solutions that you provide, can you what does that actually mean in practice?
Yes. So basically, any regulated activity would imply that first you will ensure that the product, the target market that you talk to, an investor you talk to, have knowledge to understand the strategy, the product that you're going to start to market. So there's in the target, you're only going to be dealing with professionals if the fund is geared towards professionals. So there's an element of understanding your prospect, ensuring that that prospect is of the right sophistication relative to the product that you want to push. Number two, regulated imply that you know what you're talking about. Sounds a bit of an obvious case, but the regulators want to ensure that even though you may represent one and only one manager, you are nevertheless ensuring that strategies are presented in a fair and realistic fashion, not making ridiculous promises and so on. So this is the sort of the framework you would respect, that documentation are very clear, not misleading, the right disclosure, the right complaint procedures are involved. So it sounds very petty, but it is there to protect as much the investor than it is to protect the manager. In most cases, everything goes well, irrespective of the future performance of the product. But if you haven't been careful in the promotion of your product, you're opening you're exposing yourself as a complaint, and most managers would then have to settle the complaint in one shape or form, and this is usually what we're trying to avoid.
Okay, so I mean, it's a very, very busy world at the moment, and with regards to what your focus is, with regards to European distribution, but with global asset managers, how are the economics changing in the industry? I mean, we've seen exchange of ownerships, like all funds changing hands a few times, I think, over the years. But what's happening?
So yes, you're right. Among the platform, so among the enabler, the technology enabler, there's been a lot of changes, like in many other areas where there's a race to be bigger, more diversified, bigger to cover more geography, bigger to cover more segment in each market, bigger to cover more type of products. Even though I would say, but as one get bigger, you've got also new incumbent coming, and I would just flag here that most known platform today have been geared towards very liquid. They're typically listed assets, fund, daily liquid, whereas there is obviously everybody knowing that there is a big boom, or at least an interest towards private markets, less liquid instruments, and potentially the dematerialization or digitalization of transaction that's leading to new platform being created or new solution being created from an operation perspective. From a product perspective, it's common knowledge that active managers have been challenged in the sustainability, in the reoccurrence of their performance, have been challenged from a cost perspective, and biggest challenge coming from passive solution ETFs for their ease of transaction, for their cost effectiveness, from the total expense ratio perspective. So all that is adding pressure to the more traditional avenue, not to mention what I just said before, which is around the private market opportunities where, new solutions, new structuring are being pushed in order to enable investors to access maybe not necessarily more sophisticated product, but at least investment that used to be reserved to institutional investor because of the liquidity profile they had. So a lot of changes, and like in anything else, changes leads to, I wouldn't say necessarily excesses, but mistakes being made or lack of clarification. So that's where, us as an investment advisor, we're always very eager to make sure that terms of condition are being very clear, so there's no misunderstanding, to avoid, problems, gating or disappointment from both parties.
Well, it's a good point. So I was having a discussion with Professor Amin Rajan, who's CEO of Create Research, and he's done a bunch of studies with regards to private assets going into wealth and retail channels and how different it is with regards to expectations and investors understanding liquidity and the risks thereof. How does this actually fit into an asset mix for them on a risk return basis? How do the intermediaries educate the end asset owner investor? And we're seeing credit markets a bit tricky on things being gated, redemption issues. So just on that, how do you see the education component with regards to getting everyone informed?
Well, I'd say thank you for that question. It's a difficult one. And it's like anything, as you give people more power, having tools that are more sophisticated, have tools that are more whose commitment are greater, they need to ensure that the salespeople themselves or the private bankers, whoever are in contact with the end investor, is not incentivized to omit some important aspects. Nobody reads the small print, right? So it's a case, and it's a very difficult one to gauge the right balance. I'm a true believer that if you go back at the essence of investment, everybody say time is in your favor. Use a compounding effect. Very rarely you need liquidity. Should be so important for people. The problem is we're all reading the news every day, and everybody wants to fiddle with everything. So it's a fine balance. There's very absolute total merit regarding private market and what they and what they bring to a portfolio in terms of diversification, in terms of return. But one has to highlight the fact that they're less liquid, and my worry is some of the new instruments that are being put together are highly either misleading in terms of their true liquidity potential, or if they're true to the liquidity potential, then they're not necessarily clear on the dilution that those private market will have to, assets will have to suffer because big cash will have to be maintained in the portfolio. And therefore, in both cases, my worry is that people may be disappointed. So it goes back to, education, and not overly promising.
On that kind of education component, if we kind of just shift a little bit to looking at cross-border distribution, where do managers usually get tripped up?
Well, so an easy one, I suppose, is currency hedging. So interest rate differential, where a strategy may look very attractive with a middle to high single-digit return, from a US dollar perspective or a sterling perspective. And when you switch it to euro or Swiss perspective, then the loss of 1, 2, 3%, it's something obviously that's evolving over time. Then all of a sudden that strategy is no longer that attractive, or at least the fee associated with that strategy may become a problem. And so that's number one. Number two, some markets are very sophisticated in the tools that they use, using maybe derivatives, maybe sort of a more long-short type of posture, which in certain markets are being deemed as bread and butter position, but in other markets may be deemed as more alternative. And once again, a product that may be being deemed as a core, very traditional product, when you move into a different market, becomes traditional. And again, if from a risk return perspective and cost perspective, may no longer be as attractive or as competitive than it might have been. And so that be, I say, the risk return profile and the interest rate differential, that's one, the instrument being used and the classification of the product connected to that is investor most investors have a very clear asset allocation and buckets. And again, depending what the product does, you may be, your product may be tripped between two buckets. Is it infrastructure, or is it not? Is it purely equity, or is it kind of a mix of equity and a bit of fixed income? And even if the investment thesis has total merit, the other day we looked at as an example of a global equity that was also using precious metals, with a very much capital preservation, inflation, hedging, or reinforce. So you could make the case for it, but the reality is, where would the fund buyer plug it? Because it's a bit of a mixture of different things. So that's where it's far away from investment, but has also to do with that. The other maybe final point is increasingly in Europe, the big buyers are looking at, sometimes for tax reason, like in Ireland, some of the time for simply operational ease, they're looking at asset managers that could potentially offer them different products. So they do one due diligence on the firm and therefore have access to a number of different products that favor the big providers versus the more specialist boutique, even if it comes potentially at a cost of not getting the best product. Sometimes the operational ease or the tax reality favor the bigger players.
Yeah. Can you touch on Switzerland just briefly? Because there has been some regulatory changes recently, and it is a little different, or had been historically with the EU. Can you just touch on Switzerland?
That's right. So the changes have been to get to do a bit of a Swiss version of MiFID. So MiFID is a very much the European framework that rules among other things, the distribution of funds. But the Swiss have had their own version, trying to align themselves with a bit of a tweak. So yeah, they've been a simplification of, I would say. And again, when you look at distribution in Switzerland, it's probably a bit easier than in Europe. As a result, there are more people going there, and there's more competition, and there's more noise to challenging your marketing posture. But it's a case of understanding which is your target segment. Is it professional or qualified investor, or is it a non-qualified investor? And based on that, you may have to engage with a local paying agent or a Swiss rep, which is basically a structure that will manage your local documentation for the local investor. Where it can get a bit confusing is sometimes even you sell to another business, you're more B2B. If your client becomes himself a distributor to retail, that client may require of you to be non-qualified investor ready. So you may still have you don't necessarily you cannot necessarily exempt yourself from that from the Swiss rep, local paying agent, because if you're selling to a distributor, typically a bank or wealth manager, you're very likely going to be in scope of that complication. But else, it's a relatively free market where where regulation is and the structure of the product accepted in the market is somewhat more open, a bit like in the UK, a bit more open than maybe the rest of the EU.
Okay. So Arnaud, if we look at kind of 12 months, 24 months, crystal ball, any changes on the horizon that are going to be implemented, or do you need predictions on what might be coming down?
It's a tough one. Some of it is wishful thinking. Some of it is driven by markets. So depending on where the market's going to go, you may see an acceleration or a slowdown of some development. Clearly, as I said before, a private market is popular. Evergreen fund structure is popular. LTIF is being looked at and so that whole theme of retailization, or at least providing access to more institutional-like strategies and product to the retail audience is
Can I
clearly.
ask you a question on that?
Yep.
When you say popular, is it popular with the managers trying to raise assets, or is it popular? Investors find it popular. Is there demand?
It's a very good question, and I'm not sure it's very clear. The producer, the originator, are very keen to push it.
Mm.
The investment case is sound. There's unfortunately a tendency for when a product become more pushed to retail, sometimes be a sign of the climax of that product. So the jury is out, and a lot of it is down to what simply the economic cycle will throw at us over the next few months. So it's a bit of a tricky one. Some of it is investment related. Some of it, where is the base rate is gonna stabilize itself. If the base rate stabilizes itself at a level that you basically cover the long-term view of inflation, most people will be very happy not to overly complicate their portfolio and remain in the classic listed and credit bond. If this is not the case, then there's going to be a tendency to go to more sexy stuff, in brackets, or private market stuff on the basis that they would get more return. Will they get it? So I would say it depends a bit on the economic, on inflation and interest rates. Clearly, as I said, the producer of those products, the distributor of those products, need to find a solution around the obvious pressure that the increasing dominance of passive instruments have created, and the new transactional route that they take. One fund is very disintermediated, using platform, using advisors. ETF, clearly you can trade at the click of a button on an exchange. So there's a lot of infrastructure that is no longer required with that, and get rid of it, or you find another use for them. That's the big question. So that's what pushing a lot of us. The other one that is interesting, although I'm not clear yet on where ultimately that will go, is what I mentioned briefly in introduction, is the digitalization of the transaction. Using a digital ledger, or using blockchain. So I'm not talking here Bitcoin and the like as an asset. I'm talking about the technology,
The infrastructure, yeah,
the infrastructure of it. So there's a lot of the big players are looking at, in large part because of the pressure that I've mentioned on the overall organization before, but a lot of players are looking at digitalizing the transaction using blockchain to ease the operational aspect, to make some product more accessible to smaller tickets, to more retail tickets, to create more secondaries on the back of that. So a lot of work is being done. A lot of people are also honestly keen to be the first movers in that space, or sitting on the sideline and looking at it. There hasn't been a huge amount of volumes yet either, but clearly this is something that's happening now. My personal view is that most likely, that trick, that digitalization trick, will become totally transparent, or totally hidden in the process for the end investor. They will just through an app, they will buy a fund, all the transaction, the AML, KYC, the whole execution will happen digitally. And then they will just take a confirmation within an hour that has been done. Not wiser that is gone through the blockchain, and nobody needs, and they don't need to know that is done on blockchain. But so there's a lot of that happening in the background. So therefore, the asset managers and their depository bank and chosen fund admin need to be more savvy and aware and ready for that, because I think that's happening, and it will simplify. But my worry of that is it goes a bit in the opposite way of private market, which should push people to have a long-term view on the investment, and all those progress could get people to have an easier, at the press of a button, buying and selling, and short-term view on and if one could imagine that if we all can sell everything at the press of a button, then all assets will start to behave in exactly the same way, and you lose total diversification. But that's more theoretical.
Yeah. No, that's great. I really enjoyed the conversation. And listen, we are due for a lunch, so we'll set something up. But I really appreciate your time.
That'd be great. No, pleasure. Thanks for having me.
Cheers.
Cheers.